But let's get a view on what's happening in these markets and bring in here Michael McCarthy from Tigers Brokers. Michael, thanks for your time. Just give me a read on the sense out there in the market. It seems as though a lot of people seeing these interest rates rise, wondering if really the central banks can get the inflation back under control, have just decided to ditch the markets, the equity markets in particular, commodities, the whole lot seem to have gone.
Absolutely, Ross. Every asset class is under pressure. And you're right to point out that big drop in crypto markets and share markets also under pressure. Gold prices are dropping as we speak. And it all relates to the one thing. These high inflation reads we're seeing around the globe are tying the hands of central banks. Not only can they no longer sustain those low interest rates and keep pumping money into the system, they're going to have to lift interest rates and withdraw those stimulus funds. And it's that draining of the pool, the draining of global liquidity that's affecting every asset class and putting pressure on prices across the board. Having said that, the Australian market has fared better than most. In Europe and the US, we've seen weekly drops for every one of the last 5 weeks, whereas just 4 trading sessions ago, the Australian market was within a whisker of its all-time high. So while we've dropped 8% in just 4 sessions, we're still a lot better off than many investors around the globe.
Okay, so I just want to take you to what's happening on the ground here. This market's off by, 6% in the past month or so, 7% in the past week and a half. I just want to go to the actual conditions. We spoke about the NAB business survey a little earlier. It's indicating that business conditions are pretty good here. So what I'm wondering is when we see the profit results come out in August, whether we're all going to wonder what we were doing selling shares at this time when probably we should have been buying them at the same time.
Well, you could well turn out to be right, Ross, but that's certainly not the consensus view at the moment. The concerns here are that the market doesn't price what's happening in the economy right now. It's looking forward. And the fear here is that we're entering an environment where inflation will remain high, that is, prices will continue to go up, and yet we'll see slowing growth. And that's why yesterday's trade data out of China has weighed on markets in the last 24 hours. That slump in both imports and exports to China has really made a difference. It's one of the biggest economies in the globe, one of the top 3, and that slowdown in China is gloomy for the rest of the globe as well. And that's why resources were one of the worst performers today. That sector down 2.5% as resource stocks across the board came under pressure on a lower growth scenario. So high inflation, low growth, we're talking potential for stagflation, Ross, and that is bad news for everyone.
And just briefly, the final aspect of this is the United States and its bond markets. And because now you've actually got the short-term rates higher than the longer-term rates, that's an inverse yield curve. That's almost pointing, the markets at least anyway, to a potential recession in the United States. And that worries investors around the world.
Yes, that's very concerning. The reality is that in the COVID crisis, the governments around the world and in the US expanded their balance sheets to support their economies. That came on top of 12 years of stimulus from central banks who are now unable to move because of inflation. So with both governments and central banks now out of the picture, the question traders are asking is who will come to the rescue if markets do start to seriously fall?
Michael McCarthy from Tigers Brokers. Good to have you in the program today, and many thanks for your time.
Thanks, Ross.